Okay, good morning class. Welcome back to this physical class. This is Advanced Taxation module. We're going to do a discussion on Budget 2020. Okay, as you all know, there are two certainties in life. What are they? Tax and death. All right. So there's one certainty in right now, which is COVID-19 has certainly disrupted our entire lifestyle. Right? And the second certainty is we cannot ignore it, we have to react to it. Life goes on, the classes still goes on. So let's discuss about Budget 2020. As you are aware, our Finance Minister has just delivered the budget just last month, 18th of February. In this budget, it contains a lot of measures, both tax and non-tax measures. All right? So we have learned in this module so far a number of topics. So I thought it's timely for us to just take stock of what we have learned and see what are the measures that are relevant to this course. And I'll extend it to even the basic tax module that we have learned in the year 2 previously. So the budget 2020 that we're talking about is the nation's strategic financial plan, nation's major expenditure and income. Okay, this falls outside what you normally learn. So let's look at it. Imagine you're the finance minister. I think I look more like the finance minister than you because of my age. Yeah. It's just 1 year older than me. Yeah.
Military and defense.
Okay, military and defense. What else? Yeah. In such times, you think they'll spend a lot on health, right? Health, defense. What else?
Education.
Education is certainly important. What else?
Infrastructure.
Transport. This will be your infrastructure, and also the government pays a lot of attention to the economy. So they spend a lot on economic transformation. So not only in this year's budget, in past budgets, the focus is on getting the nation ready to cope with the economic transformation. All right? So in the typical budget, expect the finance minister to take stock of how was the nation's performance over the year, identify what is the environment, the threats, and then devise a plan. The plan will really be to make sure that we have sufficient income, revenue for the nation to fund its various expenditure. So what do you think is the environment that we are living now, currently facing? I'm sure you know, right? What is the current environment? How do you describe it? What are the major threats, major factors that are affecting the growth of the economy? COVID is certainly absolutely taking center stage, not only in this our nation, but also in our neighbors and even far back to UK, United Kingdom. So they also recently released a budget, and more than half of the segment is on COVID-19. All right? So certainly this has taken. But of course, on top of that, we have the usual trends. What do you think are the issues facing the world?
US trade war.
US trade war, right? The trade war between China and US, right, is threatening the support for globalization. We are a very small open economy, and therefore we rely a lot on open trade. So this certainly puts a threat to our growth of our economy. What else?
Our surrounding politics.
Politics, yes. Not only in the region, worldwide, there are a lot of struggles for political tensions and so on. And of course, not forgetting the technological disruptions. All right, in every sector, all the disruptions will happen. And on top of all this, of course, we have also the aging population, not only in Singapore, but also in the world. So against these trends, the finance minister then devised a plan to really tackle this. All right. So in any budget 2020, they will always look at what is the long-term plan. At the same time, they also look at what are some of the near-term measures that they have to take in order to address some of the immediate problems very quickly. And of course, top in the list is COVID-19. All right. So it's very unusual. I've observed the budget for many years. For the minister to straight away delve straight into the COVID-19 is unprecedented. Usually he will focus on the long term and so on. But we are facing unprecedented threats, and so this is the plan for them. So if you look at the budget again, what has been announced is really very widespread. This is like a very elaborate buffet. There's something for everyone. So let's start off with some of the near-term measures. Are there something in this year's budget that addresses, I'm talking about tax measures. Let's put aside the non-tax measures. Someone? Cassandra?
GST is being deferred.
GST is being deferred.
9%,
Sure. Okay, let's look at it from the big picture. GST affects what kind of people?
That indirect tax rate affects consumers.
Consumers, right? So it may affect consumers, it may affect companies too. All right? Of course, GST is a tax on consumption. So if you are a consumer, you're the man in the street, if there is an increase in the GST rate, you are going to face a higher cost of living. But of course, you must note that in Singapore's GST system, is our system progressive or regressive in nature? You understand the meaning of progressive? We studied that, right from our basic course. Whether it's individual tax or corporate tax, it's progressive. The higher your income is, you pay a higher amount of your taxes. All right? The rich pay higher tax rates. Same goes for a company. If you're a small company, you don't pay 17% tax rate. You know why, right? Because of the
Exemptions.
exemptions. So you have the partial tax exemption, we have the startup tax exemption. This ensure that our tax rates will be, our effective tax rate is lower. So it becomes progressive if you're a small company. What else reduces the effective tax rate of the company besides partial exemption, besides startup tax exemption?
Corporate income tax rebate.
Corporate income tax rebate, absolutely. And in this year's budget, what was announced?
25%.
25% rebate. And each time there's a rebate, trust the government to also put a cap on the amount. It's 25% cap at 15,000, all right? So why do we have a cap of 15,000? Why not give everyone 25% without cap? So if you're highly profitable, you pay very much lower taxes. What's the thinking behind the cap? Yeah.
Is it to help
Keegan.
SMEs? For SMEs, because they earn less. So
Okay, so if they earn less, that means the most they can get is 15,000, right? So why does the government not want to be generous with the highly profitable companies? If your taxable income is 1 million, you get a 250,000 rebate. That's a lot of money, right? So why is the government not prepared to be so generous?
I think if the government is overly generous, it will also impact the government's tax revenue collection. And
Certainly,
trying
right?
to
So
help.
the government has to look at whether they have sufficient revenue to fund this, right? Let's put it down, right? So we have the corporate income tax rebate. Corporate income tax rebate. The key point is 25% capped at 15,000. Okay, what else is there? Near-term measures, yeah.
Trade losses can be carried back for 3 years instead
Okay,
of
trade
1.
losses can be carried back, okay? Let's quickly recap the concept. What is this trade loss carry back?
Like trade losses, if let's say the company business make losses, then they can utilize these losses for the previous year
Sure.
to lower their tax.
So the whole attraction, or why is it, the whole benefit of a carry back is to achieve what? So what's the main benefit or attraction for carrying back?
Is it to reduce the overall taxes paid?
Yeah, so more importantly, so after reducing your previous year's taxes, you get a 6-letter word. You get a I will fill in the vowels for you, right? You get a refund, yes. So it's particularly helpful for a loss-making company, all right? So it could be very bad. There's no income in future. Normal rules provide for carry back to immediate preceding 1 year. So it's only helpful in a situation where the current year you're in the loss, previous year you pay taxes, right? So now the enhanced carry back allows you to carry back up to 3 preceding years, all right? When you have a loss situation, what else can you do besides carrying forward and carrying back. Group relief, right? So group relief is particularly helpful if your entity is in the loss base, your current year losses, and group members pay taxes. So by transferring the loss to the group members, you are able to pay less tax as a whole. So it also makes sense from the group perspective. So I'll write this down. Enhanced loss carryback. Let's turn now to the next. Again, I focus on temporary measures. What other tax measures would you be able to highlight? Someone? Yes, Malcolm?
The new one is the option to accelerate the write-off of the cost of acquiring the plant and machinery, whereby 75% for YA 2021 and 25%
Plant
for
and
YA
machinery, yeah?
2022.
So you have 75% in year one and 25% in year two. Okay,
You cannot defer the CA as well.
okay. So I'm glad you highlighted this restriction. You cannot defer. Cannot defer. So each time you incur capital expenditure, what are the options open to you? There are three options. You can choose to claim fast. Okay, for most assets, how many years can you claim? 3 years or either claim 3 years or 1 year, right? So 1 year will be your computer equipment, your special equipment that is prescribed automation equipment. So you must belong to this list before you can claim in 1 year. Of course, having the option to claim in 1 year helps your cash flow, because by claiming straight away you reduce your taxes. All right. Whereas if you don't have the option to claim in 1 year, in most other cases you end up being able to claim over 3 years. And 3 years means you're claiming 1/3 of your expenditure. So your taxable income isn't reduced by so much. So claiming fast means 1 year or 3 years.
Claim slow over the tax useful life.
Claim over. So there's an option to claim slow, and we have discussed why. In topic 2, which when we talk about tax incentives. Yes, Chin, yeah?
I think there's also the option to accelerate the deduction of the R&R expenses, section 14Q.
Accelerate renovation and refurbishment deductions to help the smaller organizations who typically may have to carry out renovations every now and then, or rather over a short period. So there's a cap. Again, most incentives come with a cap, so that it's intentionally to help the smaller organizations. Big companies who embark on big renovation can't claim more than 300,000. Andrea, yes?
The extension of double deduction for internationalization.
Okay, internationalization expenses. Internationalization expenses. Okay. Okay, let's look at it broadly first. In any budget, the government always tries to position the nation for the long term. All right. So they are helping companies to come up with plans to ensure there's a sustainable growth. So they're encouraging a lot of companies to go regional. All right. So Singapore is too small a market, so you need to go abroad to really expand your markets, go into extra markets so that you can grow your revenue and so on. So those qualifying ones, 200% deduction, right? Either making it more attractive or tighten the rules, making it less. So in this case, is this a case of where the scheme is tightened or more relaxed?
Relax.
More relaxed, huh? What other measures we have? Tiffany?
One that would be the M&A scheme.
M&A scheme, a topic which was just covered before the break. And I'm sure you are familiar. What is M&A scheme? Mergers and acquisitions. Why do we have this scheme? It's to help companies amalgamate, grow fast, right? If a company relies on the organic growth, it could be very slow. So M&A is certainly corresponds with the government's intention to help companies deepen their capabilities. And this will result in sustainable growth for the company, etc. Stamp duty relief. So purchase of shares, remember, there are not only income tax considerations, there's also stamp duty considerations and also GST if there is. So stamp duty, you're talking about purchasing unlisted shares, you have a 0.2% stamp duty on the asset value. All right, so what is the worth of the company at the time you acquire? So stamp duty normally applies without a relief. Now, if you're under this M&A scheme, you're able to claim a relief. It's capped at 80,000. 80,000 coincides with 0.2% of the 40 million cap. In other words, if your consideration for acquisition is 40 million or lower, effectively you pay no stamp duty.
Expenses on
Expenses, double deduction for transaction costs, right? So if you are in an acquisition, you normally engage an accountant to do a financial due diligence, to really check on the target company, to see whether there are ongoing issues, etc. You may also do a legal due diligence to make sure the company doesn't take over some uncalled for liabilities, legal liabilities in future. So if you embark on this, again, under normal rules, not deductible, under the M&A, which is like another special deduction, same as your R&R. You are able to get a double deduction. But again, it comes with a cap, right? How much can you claim?
100,000.
Double, subject to?
100,000.
Louder.
100,000.
100,000, right? So at most, you can claim 200,000. If you spend 50,000, you claim 100,000. If you spend 300,000, you claim twice of 200,000. Okay, let's run through. A lot of these are temporary measures. Laws carry back, accelerating this R&R. All these three would be near-term measures because it helps the company pay less tax. All right, so it conserves cash and therefore it is considered more near-term. Internationalization and M&A would be more on long-term, helping companies deepen their capabilities to achieve sustainable growth. So distinguish between near-term and long-term. Okay, what else can you think of in terms of any other schemes which either are near-term support or for long-term growth of the economy?
Land intensification.
Order?
Land intensification.
Land intensification allowance. So what is this LIA? Land intensification allowance. Why is there a regular review of these incentives? Okay, it's a tough question. Why do you think so? Yeah.
I think number one, because sometimes, for example, businesses might not be, businesses might use the scheme for the not intended purposes of the regulation. That could be one.
Okay.
So, for example, the economy, the IRAS or people will see, whether maybe the scheme is used for its intended purpose. Yeah. And number two, I think it's based a lot on economic condition, whether what the government want to push for. So, for example,
where are the priorities to?
Okay. Whether they want to push for digitalization, then they will probably introduce PIC.
Okay.
Or they want to push for maybe, this different. Probably to tackle the COVID.
Okay, yeah, you're absolutely right. Government use tax policies to try to influence certain behavior. If they think that a certain sector needs to achieve growth, they can incentivize by giving a lower rates.
I think something that's very important globally now is the base erosion profit shifting project. So I think because Singapore is participating in it and then it wants to counter like harmful tax practices.
Okay.
So it's required by the international community to review its tax incentives regularly.
Okay, absolutely. This is spot on, and this relates to the topic which we're going to discuss after the break. So, base erosion profit shifting. Let me take this now. Base erosion profit shifting. Okay, so this is a big work. This project started in 2013. It started because a lot of global companies are shifting profits to low tax jurisdictions, paying very little tax to the countries where they operate in. So there's a lot of unhappiness, and the OECD came together and they started to think about how steps to address this profit shifting mechanism. PS is profit shifting. Because of this profit shifting, it leads to base erosion of the tax base for the respective government. So it becomes a concern, it becomes a worldwide concern. Is harmful tax competition, right? So if you are giving away low tax rates, you may be seen to be engaging in harmful tax competition. So this becomes a concern. All right, so Singapore doesn't like to be labeled as a country which promotes these low tax rates. So our position is all along that our incentives are not given liberally. It's for active companies with real substance. If you give liberally to all companies, including shell companies, it is a concern. Base erosion profit shifting, right? After the break, we will brainstorm on all the action points, right? I personally encourage brainstorming. Do you believe in my statement? You don't believe, you just have to look at the word. Base erosion profit shifting. On the reverse, it says Simon Poh encourages brainstorming. You're living in different times, and just I was just looking at it, I just saw it. Really, I was talking about bats and then I was looking at this. Anyway, to lighten the mood. So these are some of the measures. I'm sure there are more measures being introduced to this year's budget. Have I left out any significant ones? Like what? Safe harbor rules. Okay, my favorite. In a basic tax course, we learn about safe harbor rules. Another name for safe harbor rules is certainty of non-taxation. So who says tax is a certainty? Can you, Sandra, can you briefly explain what are the safe harbor rules and what have changed?
So basically, safe harbor rules have two conditions attached to it. Number one is that a person needs to have at least 20% shares, ordinary shares, in the company that they have. And they need to help for at least 24 months up to the time of disposal.
Okay.
So these are the two conditions.
So these are the two conditions. So what's the decision in this budget? Safe harbor rules.
So initially, there's a sunset clause on the.
So will it continue first of all?
Yes.
First thing is, will the scheme continue? That's the first thing you should always. So it will continue, right? Until. Actually, it was not meant to expire soon.
Yeah.
It was expiring in a few years, 2 or 3 years time. Now it's extended all the way to December 2027.
Yeah.
Okay, so that's a long time frame. So it gives more time. Cassandra, you're saying something?
Oh, yeah.
Yeah. So it's extended first of all, and again, it's the same question. Okay. Tax measures aside, are there any incentives that are affecting your students? Isn't this one of your, when you look at the budget, you will look at whether there's anything for you. Is there anything? I think there's something for you, huh? Is there anything for you? No?
Graduating already.
Graduating. Will you get the $100 to $300?
Yes.
You will, right? Why not?
Why not? I thought we will.
I mean, you don't know you will get $100 to
We will get 100 to $300.
Sorry?
Are you not? You are not 21, man.
Oh, okay. It's only for above 21, so Sandra. Okay. Of course, there's a skills future announcement, right? It started 4 years ago, so they have decided to pop up for all Singaporeans, unfortunately for those aged 25 and above. You're above 21, are you above 25? No, right? You don't look like one. Of course, there are still of other incentives, which we certainly not. But my focus is on tax measures covered in this module as well as some in your basic module. Are there any further questions you may have on this?
There's one part that they say about what no more double incentivization of.
Okay, that's also okay. Okay, this has to do with capital grants, right? Besides those direct tax measures, sometimes the government will give you a grant. A grant is just giving you it's better than lower tax rate. So you're given a grant, right? And you're not taxable on the grant. So this grant could help you to buy equipment. It could be a capital grant. It could be a revenue grant. It means it helps you to defray your operating expenses. So the usual tax treatment is clear. If this is a revenue grant, it is taxable. And it's only fair for it to be taxable because in the case of expenses, you can claim with deduction. So a grant to defray the expenses is like a negative deduction, a negative expense, and therefore it's right for you to tax. But if it's a capital grant, then the rule says that it's not taxable. All right. Besides that, any questions? There are no questions. We pause for usual break. So after the break, we will resume for tutorial 5. Thank you.